All right, we are working on the notes that are titled Developing the CAPM, and we'll probably be in this for a few videos now. And we're looking at the second page of that, where we're going to be starting out talking about what are the 7 assumptions of the capital asset pricing model. So let me bring those notes up so I can let you see what we're referencing here. And you'll see that we've got 7 assumptions. Some of them are, none of them are true, or we wouldn't need to make them assumptions. Some of them are really significant, numbers 3 and 4 in particular, and the others are just kind of helpful and don't to make life a little bit easier for us as we develop this model. So let's go through these 7 assumptions. Number 1. Investors are in perfect competition with each other. It means that no single investor has the ability to influence prices with his or her trades. This is essentially saying that we see prices, but we can't affect them. I can't go in and start buying up stock to cause the price to go up, okay? That I observe the price, but I can't impact it. I can't cause it to change, okay? Now, this is not true. I know that if I start buying up a whole lot of stock in a company, the price will go up. And if I start selling a whole lot of stock, the price will go down. But this is saying that no single investor can influence prices. We all just observe the prices. Number 2, all investors have the same one-period investment horizon, but the capital asset pricing model doesn't say how long that one period is. In other words, the CAPM is a one-period model. It starts at time 0 and ends at time 1. Well, is time 1 at the end of 1 year? Is it the end of 1 day? Is it the end of a month, a decade, or what is it? Well, it can be whatever we want it to be. We typically use years because that's the way we tend to think. It makes life a little bit easier for us, but it doesn't have to be that way. But by being a one-period model, it says we don't have something happening during the first year, first time period, which impacts what's going on in the second time period, which impacts the third time period. It says, no, we are finding an expected return over a time period from time 0 to time 1. And that's all we know. Once we get over to that time period, we start all over again with it. Number 3, investors are risk averse. Now, this is an assumption. We talked about it quite a bit in earlier videos, but it is an assumption because not everybody believes that that all investors are risk averse. But even more so, okay, what's critical here is that in number 3, it says the only things that investors care about are the expected return of their portfolio and the standard deviation of their portfolio. In fact, if you've had some statistics, you know that that means and standard deviations are the first 2 moments of a distribution. That a distribution can have a third moment, which is going to be let's see, fourth moment is kurtosis. Third moment is skewness. A distribution could be skewed, which means it kind of has a long tail to one side or the other. And then you can also have kurtosis. Kurtosis means it's going to have wide ends, or wider than you would with a normal distribution. But we're with the capital asset pricing model's assumption, we're saying that investors don't care about that. They only care about all they care about is a higher expected return and a lower standard deviation on their portfolio. And that's very important, okay, because it allows us to be able to say we can stop looking at a whole bunch of other things. All we have to look at is expected return and standard deviation. Number 4, investors have homogeneous expectations, meaning that every investor is going to look at the same data. And that's not unrealistic. I mean, we all have access to pretty much the same data with the internet nowadays. But more importantly is they all come to the same conclusion. And of course, that's not true. I watch CNBC pretty regularly, and I'll see 2 analysts get up there, and they're looking at the exact same data for this stock. And one of them says the stock's going to go up. The other one says the stock's going to come down, okay? That they come up with 2 different forecasts of that by looking at the same data. The capital asset pricing model says no. Everybody looks at the same data and comes to the same conclusions. That means that everybody's going to agree what are the expected returns for each asset. Everybody's going to agree on what is the standard deviation of every asset. And everybody's going to agree on what are the correlations between the assets. So everybody looks at the same information, comes up with the same conclusion. Now, what this is telling us is that everybody's going to agree on what the mean variance efficient portfolio is. Everybody's going to agree on what the mean variance efficient portfolio is. That you're not going to have one person say, well, I think it's these weightings on these stocks, and somebody else says it's these weightings on these stocks. Everybody's going to come up with the exact same agreement of what the mean variance efficient portfolio is. That's number 4. And number 3 says that everybody's going to buy the mean variance efficient portfolio because everybody wants a higher expected return and a lower standard deviation. So when you have a risk-free asset and you have a capital allocation line that goes through that mean variance efficient portfolio, this ends up bringing us to the conclusion that every investor will only have 2 assets. Okay, they will have the mean variance efficient portfolio and they'll have the risk-free asset. Now, what are the in what proportions do they have these? That's going to be different for different for different investors. Some investors may put a very heavy weight on the risk-free asset. Some of them may short the risk-free asset and put all of their money plus the borrowed money into the MVE. But everybody is going to be on that line that starts at the risk-free asset and goes up through the MVE, because that is giving them the highest expected return with the lowest standard deviation. And everybody agrees on what the mean variance efficient portfolio is. So what we're going to get to in a little while is, what do they agree that is? Because the capital asset pricing model, one of its keys is that not just that everybody agrees on what the MVE is, but that, well, I'd be giving it away, but I'll go ahead and give it away, is that the market portfolio is the MVE. That's one of the keys to the capital asset pricing model. Number 5, markets are frictionless. Now, I kind of like this one. I wish this one was true. It says that investors can borrow or lend as much money as they want to. We don't have to worry about credit worthiness here. If you want to borrow $1 million, no problem. You can borrow money, and you can borrow it at the risk-free rate. You can lend money at the risk-free rate as much as you want to lend there. So every investor can borrow or lend as much as they want. Also, investments are infinitely divisible. That means you can buy a half a share of stock or a quarter of a share of stock, or Berkshire Hathaway, which is trading at over $200,000 per share. If you want to buy $5 worth of Berkshire Hathaway stock, you can do it. Okay, so we're not restricted to buying and selling stock in units of shares. And then C, which would be really nice, there are no taxes. We don't worry about income taxes, any kind of taxes whatsoever, or transactions cost, the cost of commissions, or the cost of price movement when you're buying and selling there. This is just going to make life a little bit easier for us. Number 6, there is no inflation, and there's no changes in interest rates. So in essence, in the CAPM, there's only one interest rate here, and that is at least that we're going to be looking at, and that's the risk-free rate. And it starts at 0, goes to time 1. It has a standard deviation of 0. That's why it's risk-free. So it does not change. It cannot change. And there's no such thing as inflation here, so we don't need to worry about that either. We don't need to worry about, are we talking about real dollars or nominal dollars? There's just only one, okay, and that is dollars. And then number 7 says that capital markets are in equilibrium. That means prices are never moving. They will move, and they have moved, but it's kind of like a quantum leap, okay? So suppose a price of a stock is right here and some new information comes out about the stock. It instantly, boom, moves up to where its new price is based upon that information. It doesn't kind of gradually move up. Okay, it boom instantly moves. So whenever you look at prices, you are looking at prices that reflect all the information that is out there, and they're not in the process of moving. They have already moved there. So that is the assumptions of the capital asset pricing model. I want to emphasize that they're all false, okay? Otherwise, they wouldn't need to be assumptions, but they're going to make life a little bit easier for us in terms of being able to develop the capital asset pricing model. And let's move on here for a second to our um, our picture of what we're now going to call the capital market line. Because as I mentioned to you, the capital asset pricing model says that everybody agrees on what the mean variance efficient portfolio is. And it can be proven, and it's not a simple proof, okay, but it can be proven that when we have all the assets in the world to choose from, that the market portfolio is the mean variance efficient portfolio. So if we're taking a look here, okay, we can see that is the market portfolio. Here is our hyperbola right there. And this is not a hyperbola that has 2 or 3 or 4 assets in it. It has every single asset in the world and every combination of assets in the world inside of it. So every stock, every bond, every piece of real estate, everything that is traded, everything that has a standard deviation and an expected return is contained inside this hyperbola. But there is one asset that has the highest Sharpe ratio. And if our risk-free rate is over here, okay, if I want to access this capital market line, which is the capital asset line, which goes through the market portfolio. So the capital market line is just the name of the capital asset line that goes through the market portfolio. If I want to access this line, which dominates everything in the hyperbola, if I want higher expected returns and lower standard deviations, the way I can access this line is by putting some money in the risk-free asset and some money in the MVE, the mean variance efficient portfolio. And the MVE is the market portfolio when we have all the assets in the world to choose from. So important to understand exactly what the market portfolio is. The market portfolio is sum of everything. The market portfolio has at least some of every single stock in the world in it. It has at least some of every single bond in the world in it. It has at least some of every single piece of real estate in it. It has some diamonds. It has oil. It has coffee beans. It has every commodity that is traded. There's even debate as to whether it includes human capital, okay, which is traded. I mean, we all trade our time to our employer for the money we get. So there's even some people who say, yeah, well, human capital needs to be in there. Well, as you can see, nobody can possibly own that, okay, some of everything. And not only that, but it's not just any old amount of everything, but it's a specific quantity. It's related to the market capitalization. The larger assets by market capitalization are going to have a larger proportion in the market portfolio. The market portfolio is what we call a market value weighted portfolio. The largest assets get the largest weighting in there. The smallest assets get the smallest weighting. Well, nobody can possibly have some of all of those assets in exactly those proportions. So what we have to do is we have to come up with a proxy for it. We say, okay, well, if we can't really put together the market portfolio, what's something that's reasonably close to it that we can put together? And what we typically use is the S&P 500. The reason why we use the S&P 500 as our proxy for the market portfolio is we've got lots of data on the S&P 500. We know what the S&P 500 was trading at last week, last year, 10 years ago, so we can do tests, okay, which are very helpful to do. And B, the S&P 500 is constructed the same way as the market portfolio in terms of the weights. The S&P 500 is weighted so that the largest stocks, which as I'm saying this is, I believe it's Amazon and Alphabet and Apple and Microsoft, okay, maybe not, I don't know what order they're in right now, but those are basically your largest stocks by market capitalization. They're going to get the heaviest weightings in the S&P 500. Now, the smaller stocks, and there's no small stocks in the S&P 500, but the smaller of the 500 stocks will get lesser weightings. But of course, the weightings have to add up to 1. Now, the S&P 500 is not the market because it's only 500 stocks, and there's 4,000 and some out there, I believe. It only has US stocks in it, no foreign stocks. It has no bonds, no real estate, no human capital, no commodities, no anything else. So it's not the market, but it is constructed the same way as the market portfolio in terms of the weightings, and we have data on it. So the question now is, and this is an interesting question that I don't have an answer for you on, is the S&P 500 located within the hyperbola right near the market portfolio, or is it a long way from it? And that's actually been debated with a number of different academic papers, okay? And I've read some papers that say it's impossible to know. I've read some other papers that say, yeah, it's got to be really close to it here. And I've read some papers that say, it's probably too far away to really be a good proxy for the market portfolio. But at any rate, it is the most commonly used proxy for the market portfolio, so we will use it. So when we are putting together different models, we will use the S&P 500 as an approximation of, or a proxy for, the market portfolio. And the reason why we're interested in the market portfolio is because when you have all the assets to choose from inside this hyperbola here, okay, whoops, didn't mean to do that. When we have all the assets to choose from inside that hyperbola, the MVE is going to be the market, the MVE is going to be the market portfolio. And so we need something that's going to be a representation of that market portfolio. And we're going to use the S&P 500 for that.